This is Fintech Insider News. This week, Checkout.com partners with Spotify, Robinhood launches individual savings accounts in the UK, and Nubank, Revolut and Starling all set their sights on the US. We'll be tackling all of this and more on today's news show.
Whether you bond over streaming binge-worthy videos, watching sports recaps, video gaming, or by unplugging altogether, the 2026 Lincoln Nautilus Hybrid helps keep you connected throughout your journey. Learn more at Lincoln.com. Available connectivity features and functionality vary by model. Package pricing, trials, and term lengths vary by model. Video streaming and games are only available while parked.
Hello and welcome to episode 1036 of Fintech Insider News, brought to you by 11FS, the 5-time consultancy of the year that works with financial providers, big and small, to build the next generation of digital financial services. I'm Benjamin Ensor, Director of Research and Strategy here at 11FS. To help me unpack the biggest and most interesting stories from fintech and financial services from the past week, I'm joined by a brilliant panel of 3 guests. First of all, we have a very welcome back to the show for Dave Morris, CEO of FoundryOS. Welcome, as always, Dave. For listeners who've maybe not come across FoundryOS before, and I imagine there's a few of those, can you just give people a quick rundown on what is FoundryOS?
Yeah, FoundryOS is basically a fintech building platform for building solutions across banking and wealth, which, we're at a pivotal point in our early startup. We're just about to go live with our first customer at the end of this month. So, exciting times. Just to make that more fun, we're just finishing a funding round and hiring on top of that. So, slightly busy team right now.
Oh, congratulations. Next up, we have another return to the podcast for Stephany Kirkpatrick, founder and CEO of Orum, which joined Stripe in 2025. Welcome back, Stephany. Can you tell our listeners just a little bit about you and what you do?
Absolutely. Thanks for having me back. Yes, I am excited to be here and to talk about kind of a broad range of things happening in payments and financial services today. I'm a certified financial planner by training, so talking about neobanking and sort of the new evolution today is going to be really exciting. Spending a lot of my time thinking about some new ideas in the payment space. So it's a perfect time to be chatting about all these topics.
Just for listeners, this is not regulated financial advice, but it's nice to know we have somebody who's actually been trained on what can and can't be said. And completing our lineup, I'm also delighted to welcome back Chantal Swainston, founder of The Herd. Welcome back to the podcast. For listeners who are not familiar with The Herd, can you tell us a little bit about you and about The Herd?
Yeah, of course. And thanks so much for having me back as well. Always a joy to be on 11FS. I'm a PR consultant by trade, and The Herd is a platform that I launched in 2023 that is designed to get more women in fintech and financial services into public speaking. So it is completely free to access and free to be listed. We have over 150 brilliant women who are all working in financial services today who want to do more public speaking. And I work with journalists, events producers, content creators to help get more women basically in the sector talking about what it is that they're working on.
Brilliant. Love it. Okay, well, we have a panel. Let's crack on with the show. So our first story this week is that Nubank is advancing its US launch with approval from the Office of the Comptroller of the Currency, which I always find quite hard to say, which is why people call it the OCC. So Nubank has received conditional approval from the OCC to establish a new national bank, moving it into the bank organization phase. The Brazilian bank first applied for a US charter in September 2025 and says that it plans to open a regional bank within 18 months, pending Federal Deposit Insurance Corporation and Federal Reserve approvals. The move would allow Nubank to offer deposit accounts, cards, lending, and digital asset custody under a single federal framework. It comes as part of a broader pattern where fintechs are increasingly opting for full banking licenses, not just in the US, but across Latin America, with Nubank already authorized to operate as a bank in Mexico and planning a full banking license in Brazil. So, Stephany, I might come to you first as the American in the call. I think you're American. Correct me if I'm wrong.
I am American. Yes.
Occasionally I get that wrong, and yes, it doesn't go down well. Why are we seeing firms going for banking charters now? Is that the change of administration? Is the new administration a bit more open to it? Because it was tough to get a banking charter in the past. It seems like the doors are a little bit more open now. Is that right?
You're absolutely right. The doors are a little bit more open. And I think it's a combination of things. I think it's easy to say it's the administration. And certainly there is broader support in this administration than there has been in the last decade for this to be possible and viable. I think that is also because fintech has worked darn hard in the last 10 years to create a proving ground in the American market for what financial services could look like when it's not being built by an incumbent. The challenge with that model, and one I faced in building Orum, is that if you are not a bank, then your only access to participate in the payment ecosystem, the deposit ecosystem, is to partner with the bank. And I think we've seen historically that a lot of those partnerships can go wrong for a variety of reasons. Banks perhaps less prepared to manage what a fintech might be up to, size and scale overwhelming the size of the bank and its ability to manage compliance, have all caught up with us. I'll spare you the headline recaps. And so I think it is a combination of both like hard-won efforts in the market to show that there's demand for better financial services products broadly, and also challenges that if we let the existing model be the only model in which a fintech must partner with a bank, and groups of fintechs all sit with banks where transparency is lesser, there's actually a real reason why the administration and the OCC in this case should want direct registration, which is deeper insight and further oversight into the activities of that organization. And I think fintechs today, especially ones that are scaled and established like a Nubank, who operate at tremendous scale in their home market, have an advantage from a regulatory perspective over, let's say, a handful of, young folks in the Valley or in Brooklyn working out of their home offices kind of for the first time coming up with the concept of banking or financial services products. So it lends nicely to opening the door for both international entrants and national existing companies to apply for these charters. Historically, Varo was the first in the fintech ecosystem to apply and win a charter over many, many years. Right?
I was going to say, it took them ages, didn't it?
Forever. And it was considered, sort of unlikely that others would be granted that chance. Now, Varo's still on the map, new leadership. So it'll be interesting to see how they participate in this among others. But the number of, I think, sort of established players is still quite limited. And when you think about even the distribution of what today banking looks like with the top 20 banks, there's room for specialized products to exist in the market. And for these banks not to feel like they're selling you something. It's one of the things I love the most actually about one of my favorite products, which is Mercury's new personal account. They're positioning their products around helping you, allowing you to invite your accountant or your financial planner to see limited insights into your account. How novel for the first time, meeting a customer where they really are, thinking about giving you, 20 times the level of FDIC insurance that a normal bank gives you. It increases trust. It increases the feeling that financial services is for me, not against me. So I'm excited about the fact that we're seeing regulatory doors open more broadly. And I'm actually speaking to you all from the FinTech Exchange Conference here in Utah, where shortly I'll take the stage and we'll be talking with some other regulatory bodies about why this is happening. So perfect timing to have this conversation.
It's fantastic. I just love it when fintechs or new thinking just comes up with better solutions for customers. Chantal, what do you think of this story? Do you think it makes sense for Nubank to try and get an American license? I suppose maybe a bit weird for a firm called Bank to not have a banking license.
Yeah, I mean, I think we've seen so many different companies try and get banking licenses in America, right? It's a path that lots of people have tried to tread. I do feel like Nubank has obviously got such a fantastic footprint in LATAM that they've got a really existing strong brand and customer base that they could, if anyone could have a good go, it should be them. They understand the market really well. And I think the pursuit of getting the right regulation as a priority for fintechs now is absolutely the right one. I think there was a period where people were building products and creating things and then finding out at the wrong time that they didn't have the right license, they didn't have the right certificate, or they couldn't launch it, and then they had to start the regulatory protocol, when they're halfway through building something. So I think the prioritization of regulation is what you'd expect to see from fintech becoming a more mature market. So yeah, I think it's going to be a really exciting time. I think the challenge is going to be whether or not they can replicate the same success they've had in LATAM in America. And I think that's what a lot of companies struggle with when they try and break the US. And I think also then there's the worry of whether or not that's going to be a distraction to their existing business model, which is particularly successful in LATAM. So I think it's going to be interesting. It's definitely not a given. Always want to see companies do well when they're taking a risk or expanding. But yeah, I think you've got to start with the licenses, right? You've got to have the framework to actually be able to offer the products. That's the first step. So
I want to come back to one of your points in a moment, but I want to bring Dave in first. Dave, one of the things Stephany was talking about there was earlier was the sort of difficulty of firms working together, and the sort of various trials and tribulations that the firms have had through partnerships. There have been some hugely successful partnerships, and there have been some unhappy partnerships. Do you think part of what's going on here is Nubank has sort of looked at potentially partnering and said, actually, it'd just kind of be easier if we just try and get our own license?
I think, with it being easier now under the current, I was going to say regime, it's terrible, not the phrase you want to use, is it?
Administration,
to actually get to, you've got your own, it's all in your own hands, you're in control of it if you've got it is your license. And I think you don't have any of the worry about partnerships and things. And they're a behemoth. They're such a monster organisation, Nubank. They're dwarfing customer numbers everywhere across everyone else. And the majority of that in Brazil, obviously, but they're rapidly, as they're growing in Mexico, they'll be double Revolut of customers this year. Even if Revolut hit their target numbers of growth, they will be double that. So there is no value for them in partnering that I can see. They, getting their own destiny in their own hands, their own control of being, with a full charter, that has to be the right play for them. Be interesting where they target regional in there as a start point in there. You've got to think somewhere, where there's probably quite a strong Latin American base to go, sort of California, South, Florida, somewhere like that as their start point, because they obviously will have to start regional where they go from the charter perspective.
Yeah, because Stephany, I wanted to bring you in on that point that sort of Dave's just made and Chantal was making earlier about, so where Nubank might succeed in the States and so on. And is it actually an advantage being Latin American? Because yes, there's always digital banks in the States like SoFi and Varo and Dave and Chime and so on. But actually Nubank is able to deliver multilingual apps, and building an app in multiple languages is not completely trivial. So does a firm that already operates in Spanish and Portuguese have an advantage with the 45 million Americans who speak Spanish?
Absolutely. So I started my career in financial services, working actually in the retirement space, helping folks enroll in their 401k plans. And a big number of the folks that I was working with were Spanish dominant language speakers who had very little understanding of the US financial system. And what I took away from that, what I think is true now still many years later, is that language is a real barrier and trust is hard to earn. Folks who have watched Nubank rise understand that what they've really done in their home markets, both initially in Brazil and then across LATAM, is to build trust at scale. And I think targeting culturally specific communities, not just geographical, although I think Dave makes a great point. To Chantal's question, can they win in the American market? We've seen N26 try to come over and do this in US and pull out. I think the reason why it's different now for Nubank is that they really did focus on a trust component. It's a culturally specific community, one who needs to send money cross-border, potentially more often, and also who benefits from having credit and education and transparency as a part of the product wedge. And so I think it's really going to be very interesting to see I know if I were in a situation where I didn't speak the dominant language, but I wanted to participate in the financial services offered in the country I'm living in, I would feel a real challenge personally to feel like I understood what I was buying, signing up for, what the restrictions were. And I have yet to see anything in the US other than maybe when you call the bank, the option to push 2 and hear options in Spanish solve for this. And where Chime has maybe solved for the challenge of income support, lesser wages, more challenges in living with day-to-day finances, they too have not really solved for something that is culturally and linguistically different. And so it's going to be very interesting to watch this entry.
And I'm very wary of underestimating Nubank, as Dave said. They've been phenomenally successful. So let's see, can it be the foreign digital bank that finally makes serious inroads into the United States? Let's see. Okay, well, our next story is that Checkout.com has announced a strategic partnership with Spotify. So Checkout.com has launched a global payments partnership supporting payments for more than 280 million paying subscribers of Spotify across 180 plus countries. There aren't that many more than 180 countries. According to the report, Spotify will use Checkout.com's Intelligent Acceptance, which is an AI-driven system that dynamically routes transactions in real time to maximize acceptance and reduce payments failures. The deal also includes network tokens and authentication services designed to keep recurring subscription payments secure and uninterrupted. To find out more about the partnership, we spoke to Rory O'Neill, Chief Marketing Officer at Checkout.com.
We're really excited to announce a new strategic partnership with Spotify. It's a great example, of course, of a global digital business that we at Checkout are really built to support. Everyone remembers their very first Spotify playlist. It's the way music was discovered and shared, and now, of course, extended to podcasts and audiobooks and many other things. Spotify serves hundreds of millions of people across their 180 countries that they operate, and that means that their payments have to work really smoothly, reliably, no matter where anyone is signing up from or renewing a subscription. And of course, our job at Checkout is to make sure that those payments just work. Nobody notices them. They just, they work really behind the scenes, totally invisible. With this partnership, we're providing Spotify with global acquiring. We're going to process payments locally around the world. On top of that, Spotify is using our intelligent acceptance technology, which is deeply embedded with our proprietary AI tools and real-time data, basically to optimize the way that payments are routed and failed transactions are minimized. Ultimately, we boost Spotify's payment performance. What makes this partnership so exciting is that for Spotify, they set the standard for subscription digital experiences globally. And we're proud to support that and powering their payments behind the scenes.
Dave, I'd love to bring you in first. I mean, what's the deal here? Why does it make sense for Spotify to sort of go with a single global partner rather than doing what it was doing before, where it was working with different partners in different countries and had a sort of variety of different payments providers supporting it? What do you think's maybe triggered this? Is this about scale, efficiency? What's the story here?
I think it's a combination of different things. It's a similar, the same partnership with Checkout was Uber did at the end of last year. Ultimately, payments now is utility for this sort of organization. It's not something they want to have to look after themselves or have to build. It's about bottom line for them on this. If you look at that sort of 280 million paying subscribers, if you were to sort of take 1% of that they managed to sort of fix the failure rates on, that's about $25 million a month. It's real scale in this that they can manage on that side of things. And why would they even attempt to build any of this stuff themselves or do anything different when you've got that sort of scale available to you and the sort of uplifts that they're getting from the intelligent routing and the drop in failure rates, which they've got a proven record on this, with what they've done with other customers. That for Spotify, I think it gives real advantage for making sure that they keep their revenue from subscriptions coming in cleanly without, just to take out a small percentage of failure rate is a massive win for them.
Stephany, what did you think of this? Are there other sort of global payments services providers that are perhaps feeling a bit sore that they lost out on this deal? I mean, Spotify is a pretty good client to have, right? What did you make of this news?
It is a very interesting decision. And I think seeing how Spotify's stock is performing on the news is also interesting. I kind of tend to see this as, less about a PSP decision and more about payment performance. And at the infrastructure level, one of the reasons why I think, despite all the money and time and resources, it doesn't make sense for Spotify to build this is that checkout is ultimately selling optimization, which is one of the hardest things to execute on at global scale. And it's a bit of a defensive growth move because, we're seeing in just looking at the financials for Spotify that, subscription and churn are a challenge for the business. And while that's been kind of a strong consumer model for a long time, holdback on that could be a substantial financial risk for the company. And so this, perceived 1% uplift, it is, like Dave said, quite a large amount of recovered dollars. When you think about hundreds of millions, billions of dollars that are flowing through a recurring payment cycle, which is a little bit different than, let's say, a retail e-commerce checkout experience, which occurs perhaps once and once in a while. These regular recurring subscription businesses require incredible amounts of optimization. And that is where checkout has invested substantial resources, is knowing, for example, in what geography does using something like 3DS, which is a fraud control on the card networks, work well and actually improve acceptance rate, and where does it not? And that's one example of many when you kind of dig into the very deep infrastructure layer of what has to be considered when you're a business at the scale globally that Spotify is. So I think this is very, very much about that optimization over just purely what a PSP individually can provide. And that's been what Checkout's, deep investment has yielded. And they have proof points, I think, from others. So this is maybe less of a gamble than it might seem in terms of following in the suit of others who deal with these same issues at the same scale.
Yeah, it doesn't strike me as a gamble. I think it's a super interesting move. Chantal, I'd love to bring you in. We just heard Rory talking about the use of artificial intelligence, and that Checkout.com is sort of using AI to try and optimize some of the transaction routing and so on that Stephany was just talking about. Do you think that's hype, or do you think they probably are actually starting to use AI in some of the transaction optimization? And I realize it's a horribly technical question and you may not know the answer, but do you think this is a bit of a sort of AI wash, or do you think they actually probably are testing AI?
I would hope that they are, because I think the more accustomed I get to seeing AI in payments, the more I almost wonder how we did it without. And I think, especially when it comes to optimization and working out which route you're going to send money to, and you've got to make that decision in less than seconds, you're going to need the best kind of technology to be able to make that decision. So I would expect that to be the case. And I think I can imagine Checkout being a company that invests well into their AI and is doing this on a good level. The thing that I found interesting about this, and this might be my lack of understanding of Spotify's payments stack, but trying to understand where Checkout fits and whether or not this is kind of an exclusive relationship for the subscription. Because I was just wondering whether or not it's, the thing that we've got in here is Spotify is operating in 180 different countries. That's going to be a lot of different people with a lot of different financial behaviours who pay differently, who act differently. Is committing to one PSP to operate for all of those different customers the right choice, or are you better off looking at an orchestrator who can then combine all these different PSPs for those different countries? I couldn't quite work that out. The only thing I could find online was that they used Stripe for I think for creators. So if you're like a podcast or a musician, you get paid out via Stripe. But I couldn't quite find too much more information on the rest of the payments that Spotify use. But I imagine it's very complex, and I was just trying to work out where this fits into what I'm sure is a relatively big and relatively messy payments back end. I think that was the bit that kind of interested me more.
I believe that checkout.com is effectively the orchestrator you're talking about. The checkout.com is orchestrating a whole network of partners, which previously Spotify was doing. So previously Spotify had sort of payment service providers in Germany and Canada and the United States, etc. And then to Stephany's point, what a big orchestrator brings you is a better understanding of what's the best way of doing it in each country for each type of person.
Yeah.
Then it makes great sense.
Rather than checkout historically of having one PSP in Germany, Spotify having one PSP in Germany, this will give them an option through to sort of route through 5-6 different ones, which is the most optimal for a particular bank or a particular card type that's in there.
Interesting.
And so they've got... Is it an AI play? Depends what you call it. Probably not AI from an agentic view of the world, but AI from more machine learning and heavy lifting of data perspective. But certainly, complex models driving all that routing for sure.
Oh, there you go. Every day's a school day.
So as part of the announcement on social, Checkout used the pun, "Don't stop receiving." So we asked our community for their payment-based music puns, and we got back all the small fees. We found love in a cashless place. Don't look back in transfer. Every tap you make. Hit me with your best card. So wonderful contributions from our community. Have our panel got anything to try and top that?
Let's bring some Britney Spears in the mix. Oops, I did it again. Smart retry edition.
Nice.
Big fan.
Nice. All right. On that note, we will take a quick pause here and be back very shortly.
This episode is brought to you by Indeed. Stop waiting around for the perfect candidate. Instead, use Indeed sponsored jobs to find the right people with the right skills fast. It's a simple way to make sure your listing is the first candidates see. According to Indeed data, sponsored jobs have 4 times more applicants than non-sponsored jobs. So go build your dream team today with Indeed. Get a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
Now for a quick break from the headlines to tell you all about our latest Insights pod. Want to know what's coming next in financial services user experience? Drawing on insights from this year's 11FS Pulse report, we dive into our 6 biggest user experience predictions for the next 12 months. It's out now. Just head to the podcast below this one. Okay, our next story is that London fintech Teya is launching in Spain and Italy amid European expansion. This expansion means that Teya, which was previously known as SaltPay, now serves customers in 9 countries across Europe, including Croatia, Hungary, and Portugal. According to Teya, the growing SME economies of Spain and Italy present a significant opportunity for the fintech to become a financial ally to small businesses. Founded in 2019, Teya offers point-of-sale solutions with fast settlements, business accounts with a Teya card, and flexible credit, all managed through a single app. The company is backed by a series of investors such as Tiger Global and Ribbit Capital, employs more than 200 staff, and posted turnover of £19 million in 2024, more than doubling its turnover the previous year. There's a lot of stories about payments this week, as so often. Chantal, what do we think about the opportunity in Spain and Italy? Obviously, big economies. Is that a logical move for a fintech based in the UK and Portugal?
I guess there is, I think they're as good a country as any, right? I think it's my knowledge of payments is pretty UK specific, but I can see how there's a lot of SMEs. I can see how there's a lot of entrepreneurship. I always think of Spain and Italy. I think of lovely small cafes that you've got to have a point of sale. Like, I can see how that would make a lot of sense as a place to expand. And yeah, I guess I was trying to see if there was kind of more information as to whether or not they'd focus there as a next step for a reason. I don't know if they've got people in the business that know that market particularly well, or if they've got there's probably demand that they've seen people asking for it to be kind of released in those markets. I'm sure they will have had good reasons to pick those first. Yeah.
my hunch is that because they've got operations in Portugal and they're working in Portugal, Spain in particular is a very easy move from Portugal. And so then if you're moving into Spain, then Italy seems fairly logical. As you said, they're sort of somewhat similar economies, somewhat similar, nice weather. So you get, which I mean, and that matters because actually you're right. You need more point of sale devices when you've got sort of outside cafes and things like that. Stephany, obviously, this is already a crowded market, right? There's a lot of point of sale payments providers that have launched all around the world. How could you break into a market like Spain or Italy where there's existing providers? There's not many cafes or shops that don't have some kind of point of sale terminal. So what's new? How do you create differentiation? How do you create excitement about a new provider coming in, do you think? And I know that's a hard question. I'm asking you to write a strategy for them.
Well, I am actually really interested in thinking about what their strategy is. One, I think, them actually changing their name has a lot to do with the signal about wanting to be more globally dominant and being able to be kind of representative of a broader market than where they started initially. But specific to your question, I imagine that the point of sale options that are distributed today, if I just think about like my own experience, when someone walks up with a device that's like the size of a cell phone from the 1990s, it's clunky for them to execute that in their cafe. Or if they're, selling along Las Ramblas in, Barcelona, like some street vendor might want to be able to accept card and have better options. I can think of lots of examples within these markets for both like micro businesses and also like traditional SMBs, where just the move to being able to use the phone itself as the device for tap to pay is one, I think probably a very substantial cost savings. Those point of sale solutions are expensive to deploy, expensive to run. So just getting like more modern in that regard, and then thinking about all the things that they're claiming to package, right? Flexible credit. That sounds a lot like, what we saw Square Capital do, but it also sounds like things that Toast has specialized in, specific to the restaurant industry. So my sense is that they're going to need to find perhaps a bit more specialization. The SME economy is like a very big TAM potentially, but what is the area of specialty that allows them to enter and expand is going to be interesting to keep track of. It was less, I think, visible outside of the regionalization. But, thinking about currency fluctuations, regulatory complexity, access to financial services, perhaps in Spain and Italy, that's going to track closer to Western Europe. But as you start to go into the countries like Croatia, Hungary, they are further behind in their development of economic infrastructure. And those countries can be gateways into, further into Eastern Europe, which is, I think, a very significantly untapped market when it comes to payment modernization.
Really, really interesting. Yeah. Dave, what did you think of this story and the opportunity of serving small businesses right across Europe?
Yeah, I think they've done well in the UK because they've got particularly the sole trader market, that entire ecosystem with the debit card and the cashback on the debit card, as well as the payment side of it on that sort of business account, even if it is only on an EMI. I think that would work. That will replicate well into Spain and Italy. And I was in Spain in September last year in some quite small vineyards, and there was no way to pay without cash in a lot of them because a couple of them said I can't get a card machine from my incumbent bank without it costing me a fortune, and I don't do enough transactions on it. And so the only option was either cash or PayPal. Which then is, you kind of just stood there trying to work it out and type the numbers in between, or share a QR code between people's phones to make that work. So I think this would work well for those sort of small vendors in, whether it's a small winemaker or people in the markets or small cafes and things like that, to bring that whole ecosystem together of being able to manage your business and not just the payment side of it.
I think these are fiercely competitive markets, and I completely agree with you that there's lots of sort of underserved SMEs and so on, and there's a missed opportunity to help them. I also think there's a lot of competition from both the sort of e-commerce payment leaders like a Stripe or whatever, but also others like Molly, like Square. You were mentioning SumUp and so on. So super interesting opportunity, interesting move. And also interesting to see Teya, as you say, becoming sort of more of an emerging player. It's an interesting business because it's a bit of a roll-up of a number of different businesses sort of rolled up through acquisition and then sort of trying to shape it into a new thing. So be very, very interesting to watch that develop. Okay, well, let's move on to our final story, big story of the week, which is that Robinhood UK is rolling out stocks and shares ISAs, or individual savings accounts, with a 2% cash bonus. So with this new individual savings account, or ISA, UK customers will be able to access around 5,000 listed stocks and American depository receipts with no platform fees and no commissions. Robinhood also said that customers will be able to earn 2% back on new eligible ISA contributions when they fund their account before the 5th of April 2026. The contributions will have to be held for a year for customers to keep the full cash bonus. Jordan Sinclair, president of Robinhood UK, said, "Investing should be rewarding, not costly. It's time to give investors a real advantage by changing the incentives in a market that's made it too hard and too expensive to get started." Chantal, what do you think? I mean, Robinhood sort of shook up the American market. Now it's trying to do the same in the UK market. Do you think this is significant? Is this a big deal?
Yeah, I think it's exciting. Look, I think there's a lot of talk in the UK about ISAs at the moment, right? There's been a lot of changes from the government in terms of what we can keep in stocks and what we can keep in shares. There's been a historic educational push to get more people investing in the stock market, which is great. So I think it doesn't surprise me to see companies kind of launching ISAs. And more competition is always good, keeps costs down, or at least that's what we hope for. I think what Robinhood should be able to do well is a combination of kind of relatively passive and relatively active investing in one place. So I'm a Lightyear customer. I have both my ISA and also I have Wise shares from when I used to work there, and having both in one place works really well for me, which I imagine is something that Robinhood will be able to do, possibly as well. And I think where it gets interesting is the type of person who would use Robinhood to buy shares and do retail investing might be different to the type of person who opens a stocks and shares ISA. And I think what these companies will need to be careful of is making sure that they are, to quote you from earlier, Stephany, meeting the customer where they are, and kind of understanding what they need in the product and the service. Because if you're a novice to investing and you come in and you just want to open an ISA, and you're maybe getting funneled towards something a little bit more complex, that can be A, quite intimidating, and B, quite dangerous for the customer. And I think whilst this in theory has a lot of really good potential upsides, in an environment where we are being really mindful about getting more people into investing, but wanting to do that cautiously and safely, I think that's going to be something that regulators need to keep an eye on.
And Robinhood has sort of been looked at in the past for maybe encouraging people to take perhaps more risk than they were planning. Stephany, what, do you have a view on this? What do you think?
You know, as a financial planner, I've seen this conversation play out in a lot of different avenues. One, in the US, people laud the ability for Robinhood to actually capture the retail market in a way that no one really has previously. One of the best ways to build wealth is to invest your dollars, right? And I think that fundamentally that is something to be excited about. But as Chantal pointed out, both in the US and now with the ISA expansion in the UK, it begs the question of, how much of this is a push towards sort of active trading versus long-term sustainable investing? How educated is the saver, the investor, the end user about what they're actually getting into? And, while this is kind of like a trusted, product already that exists and there's cultural adoption for it, that doesn't mean that everyone who signs up and opens this kind of account understands that there's risks when they invest money, that there's risk of loss, what kind of decisions they're going to make, what the tax implications are of those decisions, things like that come to mind when I think about just striking the right balance. I think overall, I'm net positive both on Robinhood broadly and on this expansion. And what I like about the way the bonus is structured is this 2% isn't just, cash up front. It has to be in the account for 12 months, according to what the T's and C's say. And so I think that lends to being a little bit more in line with begin a habit of investing for the future, put money here, keep going, as opposed to just trading. But time will tell as to how, this behavior looks and what maybe under the hood is available through that account structure over time versus what today is kind of a limited set of offerings from a US market perspective.
It's also an interesting question about how are they funding that 2%? Where's that 2% ultimately coming from? I mean, you can't buy
I think it's just marketing. It's CAC, right? Like this is just, I could acquire you through ads, or I could give you a compelling cash-based reason to put your money to work in the system. So I think it's CAC.
Yeah, it may be. Dave, we were talking earlier about sort of foreign banks moving into the States, and here, of course, we've got effectively a foreign firm moving into the UK, even though Robinhood, of course, was British. I mean, he wasn't necessarily a real person, but anyway, that's a different conversation. Dave, what's the advantage of foreign companies coming into the UK or coming into any market? Obviously, they kind of have the existing infrastructure, they have the existing sort of app designs and site designs, so they can kind of launch with a fully fledged proposition. But do you think do foreign entrants tend to win out, or do the domestic firms manage to respond? I mean, what will some of the UK firms or European firms be thinking about Robinhood coming in?
Probably be interesting where they're sort of leaning towards as a demographic that they're trying to get in to this as an account, whether they're aiming more at sort of Gen Z and trying to sort of get the glamour of investing in US stocks and shares, but through a safer route of an ISA. Than going to single stocks and things like that. But, you can look and you can say, I've got my money in such and such a fund, but actually, does that mean anything if you're talking to someone, and you can actually point and say, well, that fund has got a lot of, US tech stocks or SpaceX or whatever in it. And so that becomes more interesting. My worry about this is it actually a route they're trying to actually shift people away from ISAs to actually real trading through getting people in as a start point and saying, now you're in stocks and shares, should we help you towards a general investment account? And that would be really worrying, because that's a very different person, very different education level as to how you can work in that sort of environment. And so time for me will tell as to what they're trying to do with this as to where they are. I don't think the 2% is that big a deal. That's that's not headline for what, if you look at what people are pushing to try and get people into their ISAs before the end of the tax year. That the people are offering more than that. So I'm not sure how much that will grab people, but they've got to offer something because everyone's offering something to get people into their ISAs.
Chantal and Stephany, do you agree with Dave? That concern he has that because Robinhood offers options trading, futures trading, margin investing, stock lending. These are some quite advanced capabilities. Do you share Dave's fears that the end game here might be trying to get people to move from stocks and shares investing into more sophisticated strategies?
I think it's certainly a risk that is present in thinking about what is the right mix. That said, I think for all of time, there are investors who will go straight to insert, digital brokerage account of choice and go do something that is probably unwise financially from an investment perspective due to either lack of education or just like they heard a headline. So I think in some ways it is a little bit inevitable. What I think the balance and the question here kind of hinges on is, what role is Robinhood playing in pushing products that maybe aren't suitable, and is the suitability threshold being met? So while they disclose a lot, and I'm a Robinhood customer, so I have seen all these disclosures, when it comes to doing something like, the futures market products, they disclose, they disclaim, but they don't prevent you from clicking the button and ultimately now participating in what I think many are considering legalized sports betting in the US via this product. And so it is a very fine line of like making it available for the right investor types versus encouraging use of something that is extremely high risk and lacks the suitability fit for someone whose risk tolerance, whether that's by age, total dollars that they have in their portfolio. I mean, a variety of factors come to mind. But the worst case scenario that I worry about is someone who intends to do well by putting in some portion of their savings to grow their wealth, ends up with a deep loss and is set back financially due to lack of understanding.
What do you think, Chantal?
Yeah, I totally agree. I think it's a very valid concern, and I think it's something that us as an industry and regulators need to keep an eye on. I think there was also a really interesting story towards the end of last year, I think, around CFDs, and the FCA had said that 70 to 80% of people who traded CFDs made a loss, and they were still being not just made available, but kind of pushed on some retail trading platforms. So I think there's also potentially ambiguity and a lack of transparency on how some of these retail platforms make money. Because if you're being given everything for free, then at what point are they making profits, and how are they doing that? I think there's definitely some rigor that needs to be kind of put in place for some of these companies. I do still think I'm with Stephany. I think net positive on Robinhood. I think this is hopefully doing the right thing and going in the right direction, but something we do need to keep an eye on. I think ISAs and investing, whilst they are very similar and obviously very closely linked, they are actually quite different behaviours, and I think we need to keep an eye on making sure that people understand what they're doing with their money.
Yeah, I'm in a very similar place to you. I think Robinhood's done a fantastic job of app design, of simplifying investing, of encouraging people into investing. But, I do have some questions about the business model and so on. And, Robinhood makes money in the States in ways that are difficult to do in other markets or illegal in other markets and so on. So there's some interesting dynamics behind the business. So fingers crossed, it's a positive. Okay, well, let's take a quick pause here, and we will be back very shortly. Okay, now for two stories that we don't have time to cover in full. Firstly, Chase has entered the UK insurance market with the launch of an insurance bundle. So the digital bank Chase has launched its first insurance product in the UK called Chase Protect, positioned as a simple, good value bundle of everyday cover. For a fixed £12.50 a month, customers get worldwide travel insurance, mobile phone insurance, and UK breakdown cover in a single package. The key angle here is convenience. Customers can buy, manage, and submit claims entirely in the Chase app, with the insurance offered as an add-on to a Chase current account. To tell you more, here's Joe Colchester, Head of Product at 11FS Pulse.
Yeah, so I think this is a value-adding and beneficial addition to the Chase UK app. I don't think it's a game changer, but what it is it will make the app a little bit more sticky for those users who happen to subscribe to the insurance offer, and then are therefore less likely to switch current accounts. People are pretty fickle here, and this will be a little bit more of a sticky element to the app, which is also signalling real kind of ambition and a broadening of its financial services into beyond just a banking app, beyond just banking features. Also, it has the advantage of having a lot of trust already built within the brand, so it won't have to build that up and spend money on the marketing there. And also very simple for the users to kind of just tap to subscribe because they're already KYC'd. So yeah, I think it's a smart move, and it really signals some broadening ambition that we've seen from Chase. We're pretty sure they're going to execute it well. They tend to deliver kind of with simplicity and great utility. So we'll look forward to seeing it on Pulse, and you can check that out at 11fs.com/Pulse.
Our second story is that Starling is setting its sights on expansion in the US by licensing its banking platform. So Starling is planning to grow in the States rather than by launching consumer banking, but by licensing its banking platform engine to American banks. The British bank is aiming at mid-sized American banks and credit unions, particularly those with between $5 billion and $50 billion in assets that are struggling with aging core technology platforms. Starling has set up an American presence with a New York office and a Delaware entity, and is reportedly aiming to land its first American engine clients by early next year, 2027. Longer term, Starling says it's also exploring launching its own US bank, either through acquisition or by taking on a new license or charter, partly to act as a case study for the Engine platform. So this is a super interesting move by Starling. Starling has always taken a slightly different approach to many of the other digital banks and has been promoting Engine by Starling for a while by hiring some serious executives in the States, people with experience previously working with mid-sized, smaller US banks and credit unions. Starling puts itself in a good place as a non-competitor to try and win some of those firms across to its new platform. It'll be very interesting to see whether some of the credit unions and smaller banks in the States that are sitting on older technology platforms decide to take the plunge and get themselves onto a modern technology stack. And finally, something a bit different to end the show this week. So it's the morning after Super Bowl 60, where the Seattle Seahawks faced off against the New England Patriots. To let listeners in on the production process, you're listening to this on the Monday after the game, but we record this show on a Thursday. So you all know who won, but we don't have a clue. The game was played at Levi's Stadium in Santa Clara, California, right in the heart of Silicon Valley, one of the great fintech hubs. So it felt only right to finish today's show with a little fintech Super Bowl quiz. So we're going to let everyone have a guess on each question. And please do play along at home and let us know how you did. So the first question, to the nearest million, how much did a 30-second Super Bowl ad cost this year? Was it A, 3 million, B, 5 million, C, 8 million, or D, 12 million? Who's going to go first?
I'll go first. D for me.
D for 12 million. Okay, Chantal.
I'm going to go C. I don't think it's quite as much as 12.
And Stephany.
I'm going to go with A. I think it's actually less than people think for certain spots nowadays.
Okay, well, I think I'm meant to read the answers out now, and my producer will kill me if I've got this wrong. But in fact, Chantal is right. It's answer C. It's $8 million, so well done. Okay, number 2. Which crypto company ran a Super Bowl commercial featuring Curb Your Enthusiasm star and creator Larry David, who after years of being wrong might actually have got this one right? Was it A, FTX, B, Crypto.com, C, Coinbase, or D, Binance? Who wants to go first? Chantal, since you were spot on last time.
I think I remember this one because it didn't age very well, if it's the one I'm thinking of. But I think this was the FTX.
Okay, so you're going answer A. Dave, what do you think?
Yeah, I'm with that.
And Stephany, from your smile of recognition, I think you maybe knew the answer.
I remember this one. Yes, of course, I do remember. And it is A, yes.
It was Don't Miss Out, wasn't it? And then it was, yeah, it did not good.
You're all spot on. It is indeed FTX. So speaking of ads, which company ran the bouncing QR code Super Bowl ad that sent everyone scrambling for their phones? Was it A, Robinhood, B, PayPal, C, Cash App, or D, Coinbase? Let's go Stephany first.
I feel like this one was Robinhood, but I was probably eating Doritos and not paying that good of attention, which is my go-to snack during Super Bowl.
Chantal?
Oh, I feel like a cheat being a marketer because this is the sort of thing that I do look into quite a lot. I think this was Coinbase. And I think it crashed their website as well when everybody went to go and to check it out.
And Dave, we obviously have a bit of a clue there from Chantal, but what are you thinking?
Sorry.
I remember the website crash, please. So it was Coinbase for me. Yeah.
Yes, Chantal is indeed spot on again. Chantal, have you got everyone right so far? I think you have, haven't you?
Yeah. Advertising is something I talk about too often. So.
I don't remember it from the advertising. I remember it from the website crash, being a techie.
Question number 4, our last question. This year's game is being held at Levi's Stadium in the heart of Silicon Valley. Given its location, the stadium is, of course, chock full of technology. But which of these 3 things is not real? A, self-pouring beer stands. B, checkout-free stadium concession stands. Or C, official merch delivered by drones. So I'm not going to go to Chantal first because she's got them all spot on. Dave, it's a bit of a techie one. What do you reckon?
So it's the one that isn't real.
The one that is not true, not real.
100% has to be real self-pouring beer in the States for sure. C for me, drones in the...
Merch delivered by drones. Okay, Stephany, what do you think?
I actually think that the checkout-free stadium concessions is not real. Amazon tried to build an entire empire of stores around this, and it failed. Even JP Morgan's lauded attempts at doing this at the F1 have not been over the top. So I think they're going to want to promote drones and have great marketing around that. And of course, self-pouring beer. So I think it's got to be B.
And Chantal, what do you think?
I don't know. It's between B and C for me. I would be boring and I'd go for C because I think the health and safety on drone delivery in stands at the Super Bowl would be a nightmare. So that would be my guess for that one.
So, well, the answer is indeed C, which makes Chantal our superstar, top of the class, every question right. Stephany, I'm with you. I was like, what on earth is a checkout-free concession? How does that work? Surely that's just lots of theft. But no, apparently it's a thing. You just walk out and they bill you later. You scan a QR code as you go in.
Oh, you scan a QR code.
Yeah,
okay,
you scan a code as you go in.
That makes more sense. Okay. Now I'm tracking.
Yeah.
Chantal, wow.
I think I got
need to
very
get on
lucky
whatever
there.
you're reading.
Too much of the Drummond campaign.
That was absolutely fantastic, Chantal. Well, all three of you were fantastic. I think I knew the FTX one, but I was lost on most of the others. Right. Well, thank you all so much for joining me. The show has flown by. It's been an absolute pleasure talking to all three of you. Chantal, where can people find out more about you? Where can people find out more about The Herd?
Yep, so you can find me on LinkedIn, Chantal Swainston, and you can find more information on The Herd and research our speakers on the-herd.co.uk.
Stephany, where can people find out more about you and everything you're up to?
You can find me, just as Chantal said, on LinkedIn. Give me a follow and hit me up in DMs if you want to chat payments or financial advice products.
And Dave, where can people find out more about you and FoundryOS?
Yep, you can find me, Dave Morris, on LinkedIn or at our website, foundry-os.com.
And as for me, Benjamin Ensor, you can find me on LinkedIn as well. So that wraps up today's episode. Thank you all so much for listening to today's show. If you liked what you heard, please do follow us on your favourite podcast platform of choice, and do share the podcast with colleagues or friends. If you want to join the conversation, seek us out on social media. Just search for 11FS or Fintech Insider, or you can email us at podcasts@11fs.com. So thank you so much again to my three guests, and thank you to all of our listeners. Goodbye.
Retail investment in the UK is the lowest in the G7. According to the Bank of England, there is over £280 billion sitting in UK accounts earning no interest. Something has to change. Financial firms in the UK must look at making investing accessible, contextual, and trusted through everyday platforms. That means bringing investment journeys to the point of need, alongside spending, saving, and budgeting, and within platforms that already play a meaningful role in customers' lives. We dive into this and more in our latest report, Taking Advantage of the Embedding Investing Opportunity, produced in association with Secor. Download your copy today at 11fs.com/embedded-investing.